let's talk about something that trips up a lot of people: taxes. Specifically, have you ever wondered if the money you earn outside of India is still taxable back home? It's a huge question, and the answer might not be what you think. It's actually less about where you're from and way more about where you are. So let's break it all down.
So let's just dive right in with the big one. If you're an Indian citizen, let's say you're working in Dubai or Singapore, does the Indian government actually have a claim on that income you're earning overseas?
And here's the thing that surprises most people. For tax purposes, the law doesn't really care about your citizenship or your passport. What it cares about is something called your residential status. It's a legal classification that's all about how much time you physically spend in the country. Now, this concept of residential status, it's really the key to everything. And what's super interesting is that your status isn't some permanent label. It gets decided fresh for each financial year, from April 1st to March 31st. So you could literally be a resident one year and then a non-resident the very next. So what is it exactly? Well, it's a really simple but powerful idea. Your tax status is determined by literally counting, the number of days you are physically present in India. That's it. It has nothing to do with your passport, where you were born, or where you consider home. It is a numbers game, plain and simple. Okay, so how do we actually figure out what your status is? You can think of it like a two-step process. First, we have to pass through a primary filter. Let's look at the basic test that sorts everyone into one of two big buckets: resident or non-resident. The law sets out a very clear test to answer this question. It's all based on two main conditions, and here's the important part. You only need to meet one of them to be classified as a resident for that year. All right, here are the rules. The first condition is pretty straightforward. If you spend 182 days, that's about half the year, or more in India, boom, you're a resident. If you don't hit that number, there's a second condition. Have you spent at least 60 days in India this year and a total of 365 days over the 4 previous years? If so, you're also a resident. Remember, satisfying just one of these is all it takes. Now, just when you think you've got it all figured out, the rules throw in a bit of a curveball. That second rule, the 60-day one, it doesn't apply to everyone. There are some really crucial exceptions that can completely change the game for certain people. And this slide shows one of the biggest exceptions. If you're an Indian citizen and you're leaving the country for a job, or say as a crew member on a ship, that 60-day rule is just completely ignored. For you, only the 182-day rule matters. This actually makes it much easier to become a non-resident, which, let's be honest, is often the goal for people working abroad. Okay, so let's say you've gone through that first test, and you've been classified as a resident. You might think you're done, but hold on. There's actually one more layer to this, a second filter you have to pass through. Right, so once you're a resident, you get sorted into one of two smaller subcategories. You're either a resident and ordinarily resident, which we'll call ROR, or you're a resident but not ordinarily resident, or RNOR. And trust me, this distinction is incredibly important because it determines the entire scope of your taxable income.
So what on earth is an RNO? The best way to think about it is like a transitional status. It's really designed for people who are either moving into or out of the country for the long haul. They might be a resident this year, but they haven't spent a lot of time in India recently. And this status, it offers a pretty significant tax advantage. Let's see how you get it.
Here are the conditions. You'll be classified as not ordinarily resident, or RNOR, if you meet just one of these two criteria. First, if you've been a non-resident for 9 out of the last 10 years. Or, second, if your total stay in India over the past 7 years adds up to 729 days or less. That's just under 2 full years, give or take. Okay, theory is one thing, but an example really makes it click. Let's take a classic case. An international cricketer, maybe from Australia, who comes to India for 100 days every single year for a big tournament. How would we classify him? All right, let's run the numbers. First up, that basic residency test. He was in India for 100 days this year. That's more than 60. And in the 4 years before that, he was here for a total of 400 days, which is more than 365. So, check, he is a resident. But now, for that second filter, we look at the last 7 years. He stayed for a total of 700 days, and that number is less than the 730-day threshold. And there you have it. Because his stay over the last 7 years was less than 730 days, he gets classified as resident but not ordinarily resident. See how that works? He passed the first test, but the second test put him squarely in that RNOR category. So now we get to the big payoff.
Why have we been going through all these classifications? Resident, non-resident, ROR, RNOR. Why does any of this matter so much? Well, because your final status directly determines what part of your worldwide income is actually taxable in India.
This table really lays out the consequences perfectly. Look at that top row. Any income you earn or receive in India is always taxable. It doesn't matter what your status is. But now look at the bottom row, all other foreign income. A non-resident doesn't pay tax on it. An RNOR also doesn't pay tax on it. But an ROR, a resident and ordinarily resident, is taxed on their global income. This is the whole ballgame. That RNOR status acts like a powerful shield against tax on your foreign income.
I know. That was a lot of information, but don't worry, we can actually boil this all down into a really simple 3-step framework that you can apply to just about any situation.
So here's your personal checklist. Step 1. Count your days for the current year and the past 4 to figure out if you pass that first filter, resident or non-resident. Step 2. If you are a resident, then you look back over the last 7 to 10 years to see if you're an ROR or an RNOR. And finally, step 3, you take that final status and check it against the income table to see exactly what's taxable.
You know, if you take away just one thing from all of this, please let it be this. When it comes to Indian income tax, it's not about your passport, your heritage, or where you call home. What truly matters is the number of days you spend on Indian soil. Your days literally count.
So the next time you're planning a trip or maybe thinking about a new job abroad, just remember this framework. A few extra days spent in one place or another could fundamentally change your tax return. It's a powerful reminder that when it comes to taxes, sometimes it's not just about the money, it's about the time.